For the better part of a decade, the financial world operated on a specific assumption. Bitcoin was our modern crisis insurance. The theory was that when panic hit the markets, Bitcoin would step up and act exactly like digital gold. This chart shows how that theory performed when put to the test in early 2026. Look at line A, physical gold surging past $5,300 an ounce. Now look at line B, Bitcoin chopping sideways and dropping 30% from its previous peak. The numbers confirm the divergence. The correlation coefficient between these two assets recently hit negative 0.88, the lowest level since the 2022 bear market. This leaves investors with a serious question. Has Bitcoin failed its primary use case, or have we spent the last 10 years misunderstanding the actual job it performs in a portfolio? The 2026 data shows that the two assets are no longer moving as substitutes. We are seeing a structural decoupling. Gold has reclaimed its position as the primary geopolitical bunker, a physical asset that central banks and institutions hold when the global system shakes. When you look at the 2026 landscape, armed conflicts in the Middle East, central bank accumulation, and fiercely sticky inflation, capital is moving into physical crisis insurance that doesn't rely on a software update. Bitcoin is reacting to a different set of inputs. Instead of a safe haven, it is trading more like a high-performance tech proxy. Take a look at this graph showing global M2 money supply alongside Bitcoin's price. When liquidity flows into the system, Bitcoin acts as a sponge, expanding in near-perfect synchronization with the money supply. To prove the connection, we can replace the M2 line with the Nasdaq Equity Index. The correlation here recently spiked to positive 0.72. Bitcoin tracks risk sentiment, not fear. These two assets have different roles. One is a crisis bunker. The other is a high beta tracker for global liquidity. For the modern investor, executing this theory means choosing between two very different tools. First, the bunker. This means allocating capital to physical gold bars or traditional gold ETFs, like IAU. This guarantees purchasing power preservation and immunity to technical hacks. The trade-off is that it yields 0% and offers no upside from digital innovation. On the other side is the sponge. This involves purchasing low-fee spot Bitcoin ETFs, like IBIT, FBTC, or BITB, through a standard brokerage account. This gives you price exposure to the emerging digital financial infrastructure. Over the last 12 years, Bitcoin's returns have outpaced gold by 65 times, representing an asymmetric growth opportunity that traditional assets haven't matched. But that growth comes with a cost. This matrix shows the volatility trade-off. Spot Bitcoin ETFs face drawdowns up to 70%, while gold holds a 15% range. Furthermore, SEC regulations prohibit staking these assets. You get price action, but miss the network yield. Spot ETFs provide efficient access to digital growth, but they guarantee a level of volatility that will break unprepared investors. Even within the ETF world, there are structural dangers. Not all Bitcoin funds are built for long-term holding. You need to be careful with traps like futures-based ETFs and leveraged funds. These allow some institutions to bypass custody restrictions or promise traders double the daily upside, but they come with a hidden mathematical price. This chart shows contango. Because these funds hold paper contracts instead of the coin, they must pay to roll them forward monthly. Over time, these roll costs and volatility decay bleed away your portfolio's value. In a sideways market, underperformance is virtually guaranteed. That brings us back to spot ETFs. But even here, there is a choice to make regarding how the asset is actually stored. Consider the two market leaders, BlackRock's IBIT and Fidelity's FBTC. BlackRock outsources its custody to a third-party exchange, while Fidelity uses its own vertically integrated in-house system. IBIT offers the tightest liquidity for large trades, but FBTC provides counterparty risk diversification for those who prefer an independent custody model. Choosing an ETF means avoiding the leverage traps and deciding which institution you trust with the custody of the underlying coins. Because the correlation between Bitcoin and gold is so low, holding both is no longer a redundancy. It is a mathematical advantage. This visual of a weightlifting barbell represents a portfolio framework designed for this decoupling. Your core holdings, like equities and bonds, sit in the middle. On the left side, we load the defense. You allocate 10 to 15% strictly to gold for crisis insurance. On the right side, we load the offense. You allocate 5 to 10% to spot Bitcoin ETFs to track liquidity and growth. Because these assets move independently, the barbell structure can smooth out volatility without sacrificing the potential for high returns. How you execute this depends on your psychological tolerance for risk and what you fear most in the current economy. If you are a defensive wealth preserver, you might choose to avoid digital assets entirely and allocate your alternative sleeve strictly to gold. You will likely survive geopolitical shocks and inflation, but you will forfeit the asymmetric wealth generation that has historically come from the growth of digital infrastructure. If you are a high-conviction growth allocator, you might use low-fee spot ETFs like BITB for 10% of your portfolio. You capture the liquidity upside for a small fee, but you must be able to hold through sudden market crashes. And if you are a portfolio optimizer, you execute the full barbell strategy, holding both. This requires the discipline to rebalance every year, trimming your winners to buy the assets that are underperforming. In the 2026 landscape, success is about understanding the great decoupling and assigning the right asset to the right job in your portfolio.